So obviously, how was the actually event in Miami, guys? Who obviously, Christopher, you attended, but any more people attended this event?
Yeah, I think there was about 80 people who were at the event. It was a great event. It was good. I enjoyed it. Lots of good information, good speakers, motivating. So I'm kind of got a
Okay.
renewed energy to get back into things. I attended the event about 4 years ago and just kind of let life take over and didn't really follow up on it or do much with it and
Yes.
decided it was time to get reinvigorated. So
Yes.
yeah.
Yeah. This hurricane now, so can be maybe another trigger for you, to get things done. It can be quicker. What do you think?
Yes.
Yeah. Yeah. Anybody attended the event as well? No? Okay. Okay. Good. Okay, let me start. I will share I've got 5 slides, I guess. So let me share the slides. Okay, share this. Okay. Okay, hopefully you can see my slides. So again, please interrupt, please ask questions. Let's have a discussion about these things. Again, I've got 5 slides to show you. And obviously the topic for today, why working capital is the silent killer of small business, LBOs. And yeah, let me start by this. So what if I told you that most small business acquisitions fail long term? Not most, that's probably an exaggeration, but a lot of them, not because of poor strategy, but because they overlook a simple yet critical factor, which is obviously working capital. It's the hidden force that can make or break your success after the deal is closed. And this is why I chose this title for today. As a business turnaround specialist, I've seen firsthand how working capital issues can cripple companies, especially after leverage buyouts. In fact, most of the business owners who approach me for help are coming from post-LBO transactions. So that's quite interesting. Probably over the last 12 months, I've probably spoken to dozens, maybe 2 dozens of them. So it's clear that while LBOs might seem like a smart way to acquire a business, they often overlook the impact that working capital can have on cash flow and operations. I'm not sure if you actually, anybody of you has acquired a business using LBO or using 100% of leverage to acquire this business. So we may discuss this. Maybe you've got different point of view. So you've closed the deal, you've taken over the business, but suddenly you realize that you don't have enough cash to invest in growth, which was the plan, I guess, or even keep it running smoothly, or to pay yourself, because this is why we buy those businesses. So it's one of the most common issues, because business buyers face post acquisition, the cash flow and the working capital. Again, I can give you a real life example. 15 years ago, my retail chain that I expanded very, very quickly, but I didn't account for the cash. So I would need, obviously I needed the cash to buy new inventory, pay vendors quite often upfront. So while the business was really profitable on paper, I struggled with liquidity, and obviously that caused delays and unhappy customers. So at that time, I didn't understand what's really happening, but obviously today, I'm quite clear. So most leverage buyouts, again, that's maybe an exaggeration, but many business leverage buyouts fail I'm not talking about the PE leverage buyouts because they use slightly different, I mean, not slightly, totally different strategy than, you know, we buying the small businesses. So they fail because they overlook, again, this critical detail, the impact of working capital on cash flow. And business buyers often load out on debt only to find out later that their operating cash flow cannot support the business out under the new structure. And the interesting thing is, you know, again, if you already bought business for, you know, using LBO, the financial model quite often was done by your financial broker, and that was to serve their needs. They just wanted to help you close the deal, but this financial model actually it doesn't serve you post deal. And again, that was just purely for closing the deal. So they, to be honest, they kind of adjust numbers to again to help you close this deal soon. So again, I've got stories from my life. I'm sure some of you may have stories from your life. For example, my manufacturing business. One of the manufacturing businesses I acquired faced exactly this, again, using leverage buyout, including seller note. So the company had strong EBITDA, very strong EBITDA on paper, but obviously the debt payments later on and some unexpected working capital needs drained cash quickly. So I had to restructure the debt within months to avoid insolvency. And there is always an unexpected spend in business post-acquisition. So again, these financial models done by whoever, you know, this financial brokers or maybe even your CFOs, they are not really useful post-acquisition. Okay, although the previous slides might have been quite familiar to most of you, I believe. So this next part may introduce something new. So again, I'm not sure if you've heard about this SGR. Again, we buy the business. We've got these big dreams for scaling our businesses, but how fast we can scale, how fast we can grow before running into working capital constraints. And the answer lies in the sustainable growth rate ratio KPI, SGR. Not sure if you've heard about this, but this is a brilliant KPI to follow. Again, overexpansion can kill cash flow. Growth sucks cash. And if you grow faster than your SGR, you may run into liquidity issues. So that will require external financing to support the operations. Otherwise, you will be insolvent. And again, I've got this example in my home care business in the UK. When I ran, we over the very short period of time, we increased the business, the clients' database, and obviously we increased receivables at the same time, and that created a gap in cash flow that obviously threatened our ability to pay employees on time. So that was a great example of this overexpansion. So I had to inject some cash to pay the wages, and then realize that actually our growth was much higher than what we could actually afford. So what's the SGR actually? Again, is the maximum rate a business can grow its revenue without running out of cash or requiring external financing. And so obviously I don't want to go into this, diving into these calculations. I strongly encourage you, if you don't know this ratio, I strongly encourage you to find out more about this, because this is really, really useful. So basically, you, for example, if you've got this SGR, for example, if your net income is 15%, your retention ratio, which you can see the how to calculate this, is, for example, 0.6, then you can potentially grow again without running out of cash by 10% for the period you calculated this ratio. So if you grow faster, again, you will know that at some point the external financing will be required. So guys, do you know this? Who knows actually? Who knows this ratio? Have you ever heard about this?
Marek, these are very, very good points that you have brought up. And before we go there, I think some of the basics which you have been starting from are worthwhile reinforcing and reiterating. Cash flow is king. That is a basic that every business owner will know or will have had drummed into them from personal experience. And you've given some fabulous examples yourself on that. So it's very easy for a business to overcommit themselves with what they want to do, either in growth terms or in servicing customers. So taking on board too many customers at one time means they've got to have all of the supplies. They've got to pay for those supplies quite frequently upfront. So they pay out more than they are getting. And that business model, they realize, will need to be looked at. So cash flow is king. It's very easy for a highly profitable company to run out of money in the short term and become technically or even actually insolvent. And that's not a good place to be in. And you gave the example where you had to inject money into the business, and they have to do the same.
Yes, that's a very good point, Pash, obviously. Do you know that actually I know CEOs that they, their management accounts, they kind of, analyze every month or maybe every quarter, depends on the size of the business. They mainly look at cash flow report, not the P&L. They only look at cash flow, and they only use the KPIs based on their cash flows. So this is what they're interested in. Obviously, P&L is more for their accountants to pay properly taxes, and so cash flow is and is obviously, as I showed, is directly related to our working capital, obviously. So have you got any business challenges involved when the cash flow problems were involved?
I'm glad that you've asked that question, Marek, and I know that the people on this call will probably have their own examples that they want to draw in. But the thing is that as experienced mergers and acquisitions experts, when we look to take on board, when we look to acquire a company, one of the first things that we are doing is not just having a look at what the cash flow, what the P&L is all about, what the cash situation is for the company, how much they've got in reserves, but also what is the amount of money required for, once we have acquired the business, to keep it going in the short term. So what are the salary overheads? What are the immediate commitments? What are the less immediate commitments that all have to be paid for? And to balance that, what are the monies coming in, and can those be planned for? So all of that has got to be taken on board. Now, if we don't do that, then it's quite easily the situation that the senior management team may well find themselves in a very sticky situation, and they've got to look creatively, and then they'll turn to you, the purchaser. You're now our business owner. What are you going to do about it? Is the way forward for them, and the cash flow accounting, going back to that, the cash flow as a planning tool is quite important, because as part of cash flow, we've got to be able to look at how that cash is going to be allocated. So let's just say, for argument's sake, we've got one particular item that needs to be paid for over the next 10 months. Well, is that a monthly in equal amounts? Is that front loaded? Is that back loaded? Is that, and when we look at all of this, these are considerations that we have to do, which will help us to understand what the cash flow actually is within that business and what we have to work towards.
Yes. Yes, but obviously, it's I'm sure, most of us, do it anyway, these financial models I mentioned. However, again, this is from my personal experience when people approach me, why this actually long-term, 12 months post-acquisition, why this didn't work? That's the question, because there are so many things, because we tried to grow this business, but there was no cash that could support this growth, etc., etc. And this is why, again, when we use the LBO, 100% debt financing to buy the business, which usually is the case, then we obviously have a bank loans, invoice finance, seller notes, etc. So that's we actually use pretty much 100% of the business capacity in terms of cash flow and working capital, and we cannot grow this business. And if anything happens, as I said, there's always something happens in terms of spend or whatever. So then the problems obviously come. So again, I'm very I know we all buy businesses using LBOs, but that's I'm really very skeptical about this, especially about the invoice financing. But again, that's probably for another conversation.
Marek, what you're really underlining with all of what you are saying is the need for, when we are going through the process, due diligence is examination of fact. Yeah, what are the facts that we can gather? Then, as part and parcel of that, the financial calculations. So, as part of the investment appraisal, we're looking at what is the cash position for that company. Now, when we do that, there's all sorts of factors that we need to take into account. So, when we are looking at how much money we need for this acquisition, yes, the loan note, the bank loan, the asset finance, the factoring, all of these things come into their own. But when we say, if we just use an example, hypothetical example, we need to have 800,000 to purchase this company. But if the rate, the monthly requirement for payments to go out of that company, which we now will be taking on board, the commitment of those payments is such that there is insufficient cash flow, then what we are doing is we're signing ourselves up as a failure. And we need to recognize that at the beginning. And that's why I suspect that's where you are coming from when you say that a lot of these LBOs don't work. I'm right in thinking that?
Yes. Okay, we may come back to it actually, because I've got a question to you guys about it. But I've got another thing actually. I'm not sure if you come across with this, when so a business that's EBITDA friendly might not be cash flow friendly. Again, this is another thing, another very important thing to understand, to realize. You can show great profitability on paper, I mean the EBITDA, which is profitability, while still being strapped for cash. And because we think EBITDA friendly most of the time, because again, we either want to sell the business, or even when we buy the business for the valuation purpose, we always use EBITDA. However, it doesn't mean at the same time cash flow. PE, private equity firms, actually run their businesses as EBITDA friendly, but they have very different resources to us. You may run your business EBITDA friendly if you want to sell for obviously a better valuation, but at the same time you have to realize that running a business EBITDA friendly means you have to watch your cash flow very, very carefully, because it doesn't mean you've got the cash in the business. It's actually the opposite way. So I give you an example, what the private equity firms, for example, do. This is just one of the many, many examples. So for example, to increase the EBITDA, so for example, even private equity buys a business from you. And we mostly run the business, I would say, cash flow friendly. So for example, is when you buy vehicles, you buy these vehicles on the whatever, kind of rent basis, so basically your what you pay monthly, this is your overhead. You don't buy those vehicles are not your not on your balance sheet, not often, but obviously not always, but quite often. Private equity firms, they would rather buy those vehicles for cash, and because that will obviously increase their EBITDA, and they can sell the business after some time with the higher valuations. So again, EBITDA doesn't account for working capital needs. So again, if you think EBITDA, because again, maybe you want to sell this business quickly, yeah, I think it's very useful to realize that it doesn't mean the business is healthy in terms of its cash flow. So that's probably another thing worth realizing. And probably another thing, I actually follow, among many of the KPIs, but I follow those two ratios really. So SGR, the EBITDA versus cash flow, and those two KPIs, which is current ratio and cash conversion cycle. I'm sure most of you have heard about this anyway. So again, current ratio, probably, again, that's quite easy. Your current assets divided by current liabilities, and if the ratio, ideally, if the ratio is 1.5, that means your business is relatively liquid, is relatively solvent, and not liquid, obviously solvent, and you're quite healthy. Although quite often I like to use not current ratio, but quick ratio. Quick ratio actually excludes the inventory from current assets. Again, I don't want to just kind of dive into it, but I encourage you to have a look at it, because some of these inventories, when you buy a business, whether manufacturing or whatever, distribution, you've got some stock. This stock may not be worth what the balance sheet actually says, or what the owner says it is worth. So quick ratio just exclude the stock, and only receivables and cash divide by your current liabilities, and that's ideally the ratio is above 1.5 is the kind of rule of thumb. And if you have 2 or even higher, that's not always a good actually sign, because it may indicate that you're not using your resources kind of efficiently. You're very kind of secure orientated. So probably you've got too much cash, or maybe you've got too much receivables, maybe too much stock if this is the current ratio. So that's a very, very, again, important ratio, current ratio and quick ratio. I encourage you to always analyze this. And when we analyze those ratios, actually, it's not just having the number, okay, this is above 1, but actually this number, we can analyze this number internally and externally. Internally, again, comparing to our, to other periods. So for example, quarter to quarter, or month to month, or year to year. And then, have a think, what happened, why this kind of fluctuates this way or that way. And this is a very good tool, to and to get to understand what's going on in the business, and at the same time compare these ratios to industry average ratios. So why my competitors have 1.6 where my current ratio is 1.1? It's always good to analyze this these differences. And again, cash conversion cycle, I'm not going to dive into this, but this DIO, DSO, and DPO, that's really crucial KPIs. And I actually have a story about this where Michael Dell, that was probably 40 years ago, the Dell company, they went out of cash and they were close to bankruptcy. So they hired, Michael Dell hired a very clever CFO who came, and obviously he was, I think then his name was Meredith. And he found out that the cash conversion cycle was like 64 days, if I'm correct. And he managed to bring this down to -11 or something like this. So basically what that means is they actually received money before they spent money on anything, whether that's buying inventory or buying raw materials or buying, paying labor. So cash conversion cycle, again, is worth exploring for not just for this manufacturing, whatever, any business, even service businesses as well. Okay, guys, so that's a couple of people joined. So I'll just quickly go back to my slide. So we spoke about the running a business EBITDA friendly versus cash flow friendly. What's the differences and what we should focus on? We spoke about the sustainable growth rate. I'm not sure if you've come across with this. And obviously why most LBOs, many of the LBOs fail within the SME space. So that's kind of slides today, and guys, I'm very happy to take some questions or maybe just have a discussions. Maybe your business current ratio, cash conversion cycle, and sustainable growth rate. If so, please share, because that would be very, very interesting. Thank you very much. So guys, any questions, any discussion, please feel free. Close the stop share.
So it's still recording.
No, I just closed the, probably I will close the